You buy an older rental, you spend 20 grand fixing it up before the first tenant moves in, and you assume that is a tax deduction this year. It might not be. The ATO can class that as initial repairs and force you to claim as little as $500 a year over 40 years, even if you never knew about the damage when you bought the place. In the next few minutes, I'm going to walk you through exactly how the repairs versus improvements line works and the 3 moves to stop the ATO quietly costing you thousands in your early years. Here is the number that matters, 2.5% per year over 40 years. That is the standard capital works deduction rate the ATO applies to most initial repairs and improvements on a residential rental. So if you spend $100,000, you are not deducting $100,000 this year. You are deducting $2,500 a year, slowly for 40 years. Getting the classification wrong is the difference between a deduction now and a deduction your grandkids see. First, understand what initial repairs actually means. The ATO defines them as costs to remedy defects, damage or deterioration that existed when you acquired the property, incurred to make it suitable to rent out. These are capital in nature, not immediately deductible, even if you were completely unaware of the issues at purchase, ATO. So that $20,000 fix becomes capital works at 2.5%, just $500 a year for 40 years at a 37% marginal rate. That is a $185 tax saving a year versus $7,400 upfront. The timing gap in the first 5 years alone is over $6,000 ATO. Second, learn the line between repairs and improvements. A true repair fixes wear and tear or damage that occurs while you're renting the property out, and it is immediately deductible in full in the year you spend it, ATO. An improvement is work that enhances, extends the life of, or changes the character of the property, or replaces an item rather than just restoring it. Touch up walls are tenant damage, that is a repair. Repaint the whole house as part of a modernising renovation, that is an improvement. Fix a broken cupboard hinge, repair. Rip out the kitchen for higher spec cabinets, improvement depreciated over 40 years, ATO. Let me show you the cost of getting this wrong. Say you spend $40,000 in year 1, 25 of it genuine repairs to tenant damage, 15 of it actual improvements. If a cautious accountant treats the whole lot as capital works, you get $1,000 a year deducted, about $370 in tax saved. But split correctly, the $25,000 of repairs is deductible now, giving a year 1 tax saving of over $9,000 at 37%. That is more than $9,000 in extra tax paid in a single year just from misclassification. Now the moves. Move 1. Audit your last 4 years of rental expenses. 4 years is the standard amendment period for most individuals. Log into MyGov, go to ATO online and download your last 4 years of tax return details and rental schedules. Then cross-check each expense against the ATO rental repairs and maintenance toolkit, sorting them into immediate repairs, initial repairs, and improvements. If you find genuine repairs that were wrongly treated as capital, work with your tax agent to lodge an amendment and claim the larger, earlier deduction, ATO. Move 2. Separate and document works at the quote stage. Before you approve any job, ask the tradie or builder to itemise each task on separate lines. Repair existing deck boards is very different from extend the deck by 2 metres. Mark each line as repair, initial repair, or improvement using the ATO definitions, and keep photos showing the condition before and after. File the quotes, invoices, and photos in one dedicated property tax folder. When your invoices clearly separate the 3 categories, your accountant can claim immediate deductions and capital works correctly, and your tax return mirrors that split. Move 3. Build a capital works and depreciation schedule. List all the major works since purchase that count as initial repairs or improvements, with the date, the cost, and whether they are structural capital works or plant and equipment. Then calculate the annual 2.5% deduction for each. $18,000 of initial repairs gives you $450 a year. A $12,000 kitchen upgrade gives $300 a year ATO. Check your last return to confirm these are actually being claimed and hand the schedule to your tax agent so you lock in every dollar going forward. And a bonus move on timing: many landlords do a big clean-up right after purchase, paint, patch walls, fix rotten decks before advertising for rent. Any of that work that addresses pre-existing defects is initial repairs, not immediately deductible, ATO. Where it is sensible and legitimate, get the property tenanted and treat genuine wear and tear that happens during the tenancy as the deductible repairs they are. Plan this sequence with your accountant. The order you do things in can change whether the ATO sees a repair or a 40-year drip feed. Two common mistakes. The first is assuming anything you spend fixing a rental is an instant deduction. It is not, especially pre-purchase damage. The second is the quiet one, an overcautious accountant who treats everything as capital just to be safe. In one example, $5,000 of genuine post-tenancy repairs dumped into capital works gave only $46 a year in tax saving, instead of $1,850 this year. That is over $1,800 missed in year one alone. And remember, replacing a whole item, not just restoring it, is almost always an improvement, not a repair. Put it together with a real example. Sarah, a teacher on $95,000, buys an older Brisbane house and spends $35,000 in her first year. $18,000 on pre-existing decking, plaster and gutters is initial repairs, only $450 a year deductible. $5,000 of genuine post-tenancy repairs gets wrongly capitalised, and $12,000 on a better kitchen is locked into slow depreciation she never modelled. The combined first decade cash flow cost is around $11,200 in extra or delayed tax. That is real money in her tightest early years, money that could buffer against rate rises. Let us recap fast. 1. Know the initial repairs trap. Pre-purchase damage is capital, not an instant deduction. 2. Learn the repairs versus improvements line. Restore equals repair. Enhance or replace equals improvement. 3. Audit your last 4 years and amend if genuine repairs were overcapitalised. 4. Split every job at the quote stage into repair, initial repair or improvement. 5. Build a 40-year capital works schedule so you never miss a long-term claim. And 6. Stage your pre-rental work carefully so timing works for you. If this saved you from a 40-year deduction drip feed, do me a favour and subscribe, because we break down the tax rules the ATO never explains in plain English. Next up, I am walking through how a depreciation schedule from a quantity surveyor can unlock thousands you're currently leaving on the table. Get the classification right before you spend, not after. I will see you in the next one.